today I'm going to, Alex, I'm going to make you a panelist. And going to ask you to unmute. Welcome back, Mystery.
Hey, Dale, how's it going? Can you hear me?
I can hear you loud and clear, brother. How are you? How have you been, Alex?
Perfect. Doing good. Good to hear your voice again.
Yeah, yours too, man. So, you could go ahead and share your screen. And I know that you've been approaching this as a continuum of your narrative of dollar parity with a lot of different currencies, everything moving towards that $1, even all currencies kind of in the same place before a reset. Is that still the narrative that you're, have conviction about?
That is, yes.
Okay.
Let me see. I just want to make sure I'm sharing my screen correctly.
Can you got it. Yeah.
Oh,
yeah.
Perfect. There you
okay. Looks like you prepared a nice little PowerPoint. I'm going to stop interrupting and let you go through it, bro.
No, not at all. So today, obviously, is special day. Obviously, it's the day before the U.S. election. So I kind of want to do a bit of an election special. Normally I'll talk for an extended period of time, but I thought this time, I'd make it a little bit more brief. We go over all the currencies together, and then towards the end, we kind of discuss. I get a lot of questions about what about potential outcomes of Biden versus Trump. Yeah, so we kind of like make it more of an election, kind of more interactive and more of a discussion. So feel free to interject at any time you want to.
Okay, buddy.
We get started, but yeah, so let's get started here. This is obviously part 5 of the Global Forex Parity. I still believe that everything is starting to line up as before, but in order, let's recap what happened in part 4. Some of the things that were predicted, some that came true, some that did not. First and foremost was obviously there a potential major currency reversal I predicted last time would happen potentially somewhere between October 2nd and October 30th. We did start to see a bit of a Europe macro top forming and a DXY bottom starting to form. It did hold that big 10-year channel, which I'll show here in a bit. But it managed to hold, which was our first sign of confirmation, but there still needs to be more follow-up, but we'll kind of go through that in a second. And then there'd be some sort of equity market weakness before the election. Some of the potential catalysts could have been Biden leading the polls or COVID second wave. Both of those appear to be coming true. The one thing that did not, as of right now, is gold hasn't run up past its previous high. I'll explain in detail why it hasn't. And then obviously Brexit, and Italy, even all these other sovereign crises, whatever you want to call them. So far, they haven't had any material impact yet. And they seem to be, there's no real sovereign issues yet. So that didn't happen. So let's go over
I interviewed a guy who thinks the epicenter is going to be out of Italy. Are you seeing the same thing because of the Italian banks? And politically, Italy is what you call it. So
yeah, I call it Italy. Yeah, it's
I like that. So you see that happening next year?
Out of the 3, it may potentially be the weakest. I don't know if they've also been hit really hard with the coronavirus as well. I'm sure that's had a large economic material impact as well. I mean, they used to be the epicenter for COVID. So obviously that's a big part of it. So right now, I think it's still too early to tell. But today, I think it's just news this morning that Britain and European Union are starting to have some compromise. So maybe it may not be Brexit of those 3. That's probably the least of the 3 as of right now. But I mean, that can change at any moment. So we'll go over the 4 major currency pairs in the Forex update. First and foremost, this is the euro dollar. Obviously, this is the downward bear channel continues to hold. Last time we came, it was this full green candle that had just gone up and touched that upper channel boundary, and then we had an initial reaction back below the 200 monthly moving average, and then now, as of Friday, which the month closed, October, it formed a red inverted hammer. So as of right now, stochastics are also peaking above the 80 level. And for most part right now, as of right now, it appears that this channel boundary is holding. Now, some people say, well, what about when you compare it to the previous 200 monthly moving average rejection, it then had a secondary move higher. And to say, is that possible? I mean, in theory, it is. If it does, it would negate the entire bear channel, and it would actually put the global forex parity theory.
That was a great call on that inflection point up there.
Thank you. I actually have to give you credit, Dale. Every time you invite me on, something big is about to happen. So it's actually your planning is actually the one that I have to give full credit to.
I'll take it. Coincidence is my friend. Okay.
But yeah, I mean, every time I appear to come on, there seems to be some sort of macro inflection point. But this one was no different. Yeah, and it not only was it the potential bottoming on bond yields, which I called 2 days prior last time, it actually did happen.
Yeah, but we were on the same page on that.
Yeah, and then this also did form. And up until that rejection started happening, none of this was potentially verified. So there still needs to be more confirmation, and I'll kind of go over it here in a little bit. But this is the first step of ensuring some sort of next move down can happen.
So is that last candle you have up there a monthly candle that's completed? That's October.
Yes, that was as of Friday.
Okay, so I'm gonna show you something I use. It's pretty powerful. It's a 2-candle reversal. So if you just count back from the candle that we're on right now, would probably be a November candle that you're not showing.
Correct.
And then you just count back 2 candles, see where it closed on the month. That's going to be your reversal. Okay, so that's going to take in 8 weeks to the left of price action.
Correct.
So above that price, if we close above that by the end of November, I don't know what that close was.
Then this would have been essentially a bull flag, correct?
Yeah, like a 2-month reversal is what you had.
Yeah,
with the close in October.
I still believe, and I'll go through it towards the end, but I remember the last time I showed a bell curve, and it kind of showed the historical mean average of all the topping periods and how many weeks it took. And that's how I came up with that October 2nd to October 30th peak window. But I went back and I looked back, and every major dollar bottom and euro top had a secondary back test that went back and retested that one last time, typically after 2 full monthly contracts had expired, and it'll touch it once more, and then the final trend will confirm. So I still think there should be one more pop up here on euro, even if we have a downturn here. So it may be potentially a little bit early still, with a lot of election volatility and a lot of other things going on. It may be kind of the catalyst to kind of have one more pop here.
Yeah, I'm thinking of trying the long side around your 2 moving averages that converge are about 114 or so, if we get down there.
Yeah, I think for now, I think if we were to see a euro kind of confirmation retop, it would have to be at a descending. It would have to be a lower high, and if it were to see some sort of rejection at a lower high in the just above 119, kind of 119.2, 119.4, somewhere in that range. If we kind of see a top somewhere, or maybe 119.6, somewhere in that range, then that would be a signal. Okay, this could be potentially be an actual that final macro rejection, and that would happen somewhere between November 13th and November 20th. That's kind of the tightest window I can give.
I have someone else I interviewed was talking about November 14th.
Yeah, I'm seeing a lot of I'm seeing a lot of activity in post-election. There'll be a post-election calm. I think a lot of people are betting insane volatility. I think it's actually going to be neither up nor down. I think maybe we could have some kind of a pause or reprieve, and then all of a sudden mid-November. So I'm seeing a lot of signs something big is going to happen in mid-November.
Okay.
So that's just what I'm seeing in the data. Who knows what the catalyst could be, but it could be a lot of other things. Okay, and so the next chart is going to be the pound dollar. On this one, it's still holding the 13-day moving average support, but it went up and rejected. Last time we spoke, it was trying to break through the 50 monthly moving average, but then it rejected back down. Very similar to this period in the previous green box. You see it tried to break out to the 50 many times. It failed to do so. If this pattern is to repeat exactly again, which is no guarantee, but if it were to, then in theory it suggests there may be one more drawdown to the magenta. But given how close we are to this purple line, I still think it may just try and go ahead and reject it now if it does, which would be that last kind of pop I talked about on euro. In theory, you should have, a similar pop on the pound if we can get up there.
Okay.
But as of right now, the race to parity has not begun until this 13-day moving average, 13-monthly moving average right here fails. So for now, bulls are in control at the moment, barely, but they are in controls. So until that kind of 129 levels, starts to show weakness, so far so good.
Okay.
And then on the pound euro, I know most people do euro pound, but obviously I like to do the inverted to kind of show in correlation with the rest of the theory that this major macro orange trend line continues to hold. It keeps getting pounded, but as of this point, it's still holding. So until that fails as well, there's no race to parity yet that has begun. But if you look back here to the 07-08 period, it kept hitting it over and over again, and eventually it ended up failing. And even, I apologize. And even on the, if you look here on the MACD, it crossed bearish, and it crossed bearish at the center line, which is very important. It's often a major macro bearish reversal. So we're seeing the same thing here as of right now. So as of right now, it's saying there should be further weakness, but currently at the moment, I think we're getting one last possible dead cat bounce maybe, and then we'll see from there. Okay. So, but the most important part of the entire global forex parity thesis is that the pound has to, by definition, fall faster than the euro. So this pair needs to keep trending lower, and that needs to fail in order for any sort of global parity to happen.
And just for our viewers, Alex has it paired the opposite way that we trade retail
Correct.
euro pound.
Correct. Okay. It's only to tie in with the rest of the thesis, obviously.
Okay.
And then this is the dollar monthly chart, and as you can see here clearly, this long-term purple 10-year trend line continues to hold. And I said last time when I was on that lower Bollinger overshoots on the monthly chart are extremely rare. And the reason why I was so confident it was going to reverse is when I came on last time, we were right here, like the red had been touching the purple. And it seemed like dollar was doomed, but I was extremely confident that a bounce was coming because it's only happened one other time in the last 20 years. Even here it just touched, but this is actually the only real other lower Bollinger Band overshoot that we had, and obviously it bounced off there. So I knew at some point there had to be some sort of a relief rally on the dollar, and it also did bounce off roughly the 200 monthly moving average as well too, inter-month. So as of right now. It formed a nice green bullish hammer as of Friday's close on last month. We should still see, if you look here, the 13 moving and the 50 are starting to converge and get real narrow. It did the same exact thing here during the 2014 period, but they never actually crossed. But it did kind of get stuck in this consolidation pattern for a while. I don't think it's going to last as long as this time based on kind of the activity I'm seeing. I think it'll be a little bit faster. But nonetheless, if you see there's always a red, green, red, and green, and kind of that kind of red, green. So it would suggest that we still have one more back test as well on the DXY to confirm this is a bottom. And you're even seeing that kind of red, green pattern here as well too. So I still think there's one more retest of that kind of, call it mid 92 level range. Possibly maybe some volatility or something, or maybe, hypothetically, whoever wins, they say, oh, stimulus, there's this kind of immediate stimulus euphoria, which may not pan out. And so if you see some kind of all of a sudden stimulus euphoria over the next couple of weeks after the election, but then, you get this drop back down, but then all of a sudden reality sets in, that would then establish that kind of secondary or tertiary bottom that we need to kind of move back up. So from there on, we're going to go to the Bitcoin. Obviously, Bitcoin's had a lot of activity since the last time we spoke. Last time we spoke, it broke out of that initial purple macro trend line. It popped up back up. I added these two macro resistance levels. This is the roughly 12,000 level or just above it. This has been a major resistance going back for quite some time. It bounced up, rejected off there, and then it's held this key magenta support, and then now it's broken through all the way up to the 14,000 level, which is actually where it peaked in July of 2019. So it's actually having a very healthy breakout. A lot of it's on the back of obviously some dollar weakness, but it's actually performing really well.
Yeah, I mean, I made the comment earlier, Mystery, that with risk off and a strong dollar and even weaker metals, the relative strength was in crypto last week.
It actually was. Yeah, the last 2 weeks. This is a weekly candle, so this 2 weeks period really had a lot of strength. Now with DXY potentially bottoming here, could this green hold? This is a previous rejection level. That's a possibility. It's already at the it's at the upper Bollinger right now, so this temporarily it's kind of being capped, but.
Could you see a pullback to $9,000? That's kind of what I'm looking for from here.
That's right where the close, right around the 50 moving average on the weekly. So yeah, I could entirely see that. That's not out of the question.
All right, buddy.
But yeah, so this is obviously it's good for crypto, but at the same time, if we do get some kind of a huge dollar ramp, that would weigh on basically all commodities, including crypto commodities. So it's the same. I kind of bunch them in with the same category now. But for now it's doing strong. So the real key level is 14,000. That's your real kind of line in the sand. If it can really build enough bullish pressure to break out, then it may have more to go. But if it puts any sort of topping tail on a closing basis this week, then you'll know maybe time to kind of lock in some of those gains.
Yeah. Okay.
Bond updates, U.S. Treasury yields. Last time we spoke, was actually the purple arrow. That was the week we spoke, and sure enough, It was exactly where it bottomed. I had said 2 days prior we had that kind of 40 basis point low, and I said to me that looks like that's going to be a short-term bottom, just because the lower Bollinger was so flat. I said that was the real reason, and of course that ended up holding. We're seeing a very similar MACD pattern back to kind of 2012. And I'll actually discuss this in a little bit. I did some QE analysis from quantitative easing, but you can kind of see this kind of ABC macro pattern. You got a big A wave and then a B wave rejection to the 50 and then down to the bottom. We kind of have the same pattern. We had an A wave, a B wave rejection roughly around the 50 moving average and then back down. So now it's in this kind of choppy bottoming pattern, but it can be stuck here for, over a year. This one lasted from July to July. So we still have plenty of time, given how this one started roughly March, April. This could actually go into the spring, but it did have one final rejection at the 50 moving average before it came back down and then started to, so we still have a bit of ways to go. I did say at that time that I thought it was going to be relatively lower for longer, but that if there was a breakout to the upside, it would indicate that inflation was actually starting to seep into the system and starting to kind of leak into the system. And anytime you have that, that secondary bond yield spike, that'll often hit big tech, which obviously it did in the past week or so. And it can hit other asset classes because sometimes, people view rising bond yields. Yields, not bonds, bond yields, as a possible warning signal. As of right now, there is some inflation leaking to the system, but as of right now, I still think it's going to be relatively depressed in the short term. But
we look for the reasons. Could it be with what has gone on, and really the Fed is the main buyer of treasuries across the whole curve? Auctions haven't gone well, so
they have not been very stellar.
Demand, we could have rates rise just because there's poor demand for more supply coming on the market, right?
Correct. And so my contrarian thesis to that is if in fact, and I'll get into this later, but depending on who wins the election, it will have a material impact on the timing of bond yields, because if stimulus, for whatever reason, gets delayed after the election, that's when you would see yields come back down, because then it would imply that the new issuance is not coming as rapidly as originally anticipated, because right now everyone's pricing in basically guaranteed stimulus right after the election, no matter who wins, which to me, I actually don't think that's necessarily going to happen depending on the outcome, which obviously we don't know right now. But for now, it's still going to be below the kind of 100 basis point level for some time. And I still think there'll be at least another rejection if we get back up there. And keep MACD is still rising kind of similar to how it did in 12. And QE2 was late 2011, and then by mid 2012 QE3 happened, and then it started to come back out. So
I really like the way you go back in time to find market analogs, and just want to say that you're a hardworking guy to spend the time to go back in history, trading history, to find these things. I know it takes time and
thank you, Dale. I
work
appreciate
to
it.
do
It
it.
is it is a lot of work. It's a lot of number crunching. It's a lot of
Yeah.
back testing. It's
So,
a lot of, but
so one thing I'll say about you, you're not lazy.
thank you, Dale. Really appreciate it. But I think I like to look at historical analogs because ultimately, on a short-term basis, a lot of it's noise anyway. So the longer your time frame, the more you can kind of filter out a lot of that noise, and more importantly, human nature ultimately doesn't change in the long run.
Yeah.
You know, we're very same. I mean, we're going through a pandemic that's literally following the exact same trajectory curve that it did in 1918, even though technology's changed, healthcare changed, everything changed. But what happened? You had initial primary first spike, then you had a lull, you know, during the summer months, and then the second spike was actually much larger than the first, and then that ended up being the really big one. And sure
Right.
enough, like that's exactly what's happening in Europe now. Considering all the things that have changed, ultimately human nature hasn't changed. So to me, when you look at these long-term historical analogs, I think you get kind of more of a you're able to filter out the noise a lot better and just, you know, focus on the actual data. So that's why I like to go look back in history, and especially with momentum indicators, because it kind of gives you a sneak peek. Okay, what happened the last time momentum indicators were doing this, and that kind of gives you, you know, at least some basis to go on.
Okay.
Okay, and then so then we'll do a gold update. I actually made a lot of changes this time. This was the previous chart I showed last time, but it didn't have any of the actual QE lines. So these vertical lines are actually to give a bit of a historical basis on, you know, now we're in a very liquid kind of quantitative easing phase in the economic cycle. And when QE1 first started, which was back in December 08, this is what happened to gold. And you could clearly see from there, it really started to run and have a huge spike. And then QE2 was right around late 2010. I think it was about late November, November 25th, 2010. And then from there, you saw gold have a secondary boost. QE2 actually ended a month before gold actually peaked, but it ended up actually marking the top of the cycle. And then during this period, you know, they were talking about QE taper, this and that. Well, yeah. QE3 actually ended up happening right where this final spike is in roughly September of 2012. But you can see it was actually a buy the rumor, sell the news event. It actually ended up peaking once QE3, even though QE3 had just started. By the time QE3 ended, what happened, you know, ultimately to the gold price, it took a big hit. So this is kind of showing the impacts of quantitative easing and stimulus on gold's pricing. And if you compare that to now, you know, this is where QE4, which is what I'm calling it, started, was obviously back in roughly in kind of the March timeframe. It's actually right here. So where it peaked here and then it bottomed at the 13 moving average, that's actually where it officially passed. I just moved the line over a little bit so you can actually see it. But you can see what happened. But it's important to note that QE4 was many magnitude times larger than QE1 and 3 combined. Right. So although it's had a great run and it's had a great move, it's been relatively muted compared to what it had been historically. And as of after the previous time I was on, I started seeing some odd signals that it's possible on the interim term, in the medium term, if the global forex parity starts to actually pan out here and DXY has its final macro bottom, gold is going to face a period of softening. It's not the end of the bull, it's not the end of the world, and I'll show in the next chart on a mathematical basis. But it is important to note that, you know, there are these periods where there is kind of a cooling and softening before you have that kind of next surge back up. And if we look at the MACD here, it's actually starting to peak out roughly around the same level it did last time. And if you also coincide with the RSIs, the 3 RSI peaks in the red circles, those all marked major either, you know, medium term or interim term peaks in gold before it had some sort of protracted consolidation. Now, last time I thought that if the 50 daily moving average had held while DXY was getting that, secondary bounce and there was a second pullback, that would be enough to kind of launch it up all the way to 2237. But right now, it doesn't look like, at least on this cycle, that it may happen as of yet. But anything can happen. If there's more stimulus, then yes, that's enough to ramp it back up to that upper blue line. But really, I've been saying on ChartScope for some time now, without that secondary stimulus, gold is at risk of a pullback. It really needs that fiscal stimulus to come through in order to really push it up to that final target. But as of right now, it is starting to show some signs of softening here. In the short term. And then in this next chart, this is actually the gold DXY ratio, which I showed last time, but this time I kind of added some new, here's the new line that I added. This is actually the 22.5 resistance. When we spoke last time, it was just about to clip this blue line. It was just before it did. So that was back in August 11th. And this has been a historical major resistance going back. It topped here 1, 2, 3, 4, 5 times on a closing basis.
You make anything out of it, Alex, that that gold has surpassed the 2011 high and this ratio is a lower high?
That's actually what I was about to say, is that if you look, the RSI had huge peaks at all these three, and then they ended up pulling back. Now, it's taking a step back. The reason why I'm showing this ratio is if global forex parity is going to happen, which I believe it is, I genuinely believe it is happening, you're going to have a softening period during that huge DXY ramp. And during that period, this ratio will especially get hit hard because it's a ratio of dollar versus the DXY. So not only is gold going to be going down, but dollar will be spiking. So you'll have some sort of a aggressive pullback. But I believe after DXY hits 109, when it gets up there, roughly that level, that high 100s, that it's going to actually be the best entry longer term for a super bull in gold. Because at that point, I do believe that's when you're going to have to finally, the reaper's going to come for all this debt monetization. At a certain point, gold is going to have to rebalance. But as I said in the last few presentations, until there's a unified global currency, the U.S. will not allow the dollar hegemony to be challenged by having gold go vertical. So it's not until you have some kind of fixed global singular monetary unit that gold will actually be able to trade freely. So until
how about next spring?
I think we're going to have the ramp. Well, I think we're going to have the ramp up to 2021, but I don't think the actual that huge bull is really going to start until 2022. So I think it's going to be pushed off, I think, a little bit further, or maybe late 2021, maybe Q3, Q4. But it's not going to happen right away. It's going to take some time for that dollar ramp to happen. But if you notice here, if that is that theory, it could actually be a very similar pattern to what we have here, where our 08, it had a big pullback back down during that huge ramp, and then it really rocketed up. So to me, I think this is actually a great analog for what we could actually be going through. And we may actually be going, if you look, there's a red shooting star here. There may be some sort of a softening period in the interim term while that dollar ramp happens. And then this entry down here is where is kind of an analog to what I would view that late 2021, early 2022 macro bottom before it really just starts ripping. So this is kind of on a more macro time sense. Now, for those that are short-term traders, the only reason I bring that up is just, be wary that, make sure you have your stops in place, because there is a possibility we do have some sort of a softening pullback. And every, RSI peak did result in at least at minimum a pullback to the 13 moving average, if not the Bollinger Center. And if you look where that is, the ratio would definitely be much lower. And it could even pull back all the way to this kind of 15 level, which is the 50 moving average. And if we did a reverse calculation and you did gold, you reverse calculated, if DXY hits 109 and it gets back to a mid 15s, you're looking at a low 1700, 1720, 1740, somewhere in there. So it's not necessarily going to be a catastrophic pullback, but it is, you could have, a more substantial pullback.
Okay.
And then how does this all kind of tie in together? And I actually made a lot of updates on this final chart. This is actually kind of shows the entire dollar bull channel, but then I overlaid every single gold peak and trough to kind of give some relative perspective, because a lot of people say, they say, you think, the DXY is going to go 109? Does that mean dollar's going to go to $500? Like, no, of course not. So I try to put these. Last time I came on, I said that the gold had officially broken the DXY inverse relationship on a direct basis, which is actually, I added this new vertical red line. Up until everything before this red line was essentially, everything was starting to make kind of mathematical sense. But after that, things have kind of skewed as gold really has started to kind of resurge in the global monetary order. But if we look here, the previous all-time high was at 1920 back in 2011. Then we had a kind of a bounce, and then when it retested this, when the DXY retested this a bull channel support, which was the 2014 bottom, gold was, at that point, had already dropped back down to 1346. Now this huge DXY ramp up all the way to at that time was about 100 roughly. It looks massive, but on a gold basis, it actually only hit gold $300, almost exactly. So it went from about 1346 to 1050. Yeah. And then from there,
that was it.
Yeah, that was it. And then from there, from 1050, once gold had this, pull back to the bottom of the channel, roughly, not quite, but close to the bottom of the channel, it went back to roughly 1360. So that's when it was in that kind of 5-year consolidating pattern. It kept kind of chopping around there for 5 years below 1350, 1360. And then once the DXY started spiking again, it dropped back down to about 1160. But then from here, if you look, all of a sudden from 1160, the DXY kept going up, but gold just went vertical to 1730. So this is kind of where the relationship broke. So everything before kind of mid 2019 and after 2019, you kind of have to compare with a grain of salt. They're not really, it's apples and oranges. But the reason why I'm showing this is, well, we recently, pulled back from went from 1730 all the way to 2100. But even just in this small secondary bounce, we're already back to, in the 1880s right now. So you can kind of see like the same pattern forming, if gold, or the DXY runs all the way up to a high 109, 110 kind of level. Well, you could probably expect at least a 300, 400, maybe $500 drop from the recent peak, but don't expect much more than that. I think it's kind of put everything in perspective. But even the middle magenta line right now is already at a 103, so that kind of shows you there is now there's a huge window to the upside that's potentially setting up here. But it's important to know, like during this period, all commodities across the board are going to face, headwinds, some more than others. But a lot of the base metals could potentially get hit, maybe some of the agricultural commodities. So you got to really be careful from a commodities basis. But the reason why I'm showing this is if we get, if this pans out and we end up having this huge 2014 style ramp all the way up to the top of the channel, this top of this channel is where you want to be loading up on all kinds of commodities. Yeah. Because that's going to be a long-term risk reward reversal back to the downside for the dollar, but upside for commodities. So I think as of right now, this is kind of, if you look at the MACD here, we're seeing a very similar pattern. We had a long kind of this sign consolidation, and then it fell below, and then we had a bull cross, and this is where the consolidation happened before it started to run.
What a great presentation.
Thank you, Dale. I appreciate it. And we
also ever got applause? Anyway, my trading warrior brother really, he could be your best.
No, so and one quick thing. So in this lower stochastic, it also bottomed here when that started to happen. So we're seeing a lot of confluence that this is going to happen. And then I was going to say, this is the chart I showed last time, which just showed the historical kind of bell curve average of all the euro tops and dollar bottoms. And the average between 9 and 17 weeks. We're kind of slowly starting to approach that kind of 12 to 13 range. So could we get a couple more weeks? Yeah, it's possible, but we are getting close to some sort of a macro inflection point here soon. And then last bit is the election part. I just wanted to do a potential, again, full disclaimer. I don't have any political biases. I'm not a Republican or Democrat. I'm not a libertarian. I'm not any independent or anything. To me, I I'm not a political person, but it is important to understand the political implications or what impacts they'll have on financial markets. So I'm going to cover both completely dispassionately, but to show what are the potential outcomes if one or the other wins. And so again, this is purely just a hypothesis, but this is what I believe would happen if Trump were to win. It would actually be the cleanest of the two outcomes, because more than likely stimulus would come faster than if Biden won. Commodity sectors would definitely get a boost, because I believe that stimulus will be coming faster. And anytime stimulus comes, all commodities, like a rising tide lifts all boats, it would push all commodities up. There wouldn't be any chance of a contested election like 2000, so it would kind of eliminate that market risk. There wouldn't be a lame duck period for them to stall further stimulus. It would be more risk on for equity markets, I believe, as markets would kind of, not quite a repeat of 2016, but it would definitely be a positive tailwind for the markets. In many ways, it would be kind of business as usual as it has been. The risks are, maybe some social issues. There might be some riots or something due to some disgruntled voters. And there would definitely be more DXY initial softness than Biden, because that perceived faster arrival of any sort of stimulus. Now, if Biden were to win, I think it's actually short term, it may be uglier of the two options, but after his inauguration, it would actually potentially be better. But initially, you get maybe the first week or two, you may get a pop, but it'll fade after. I do see some sort of piecemeal stimulus possibly being passed between him, the election, and if he were to be elected, it'd be inauguration. But that's a 2.5 month period, and that's an eternity in financial markets. I do believe Democrats, they'll control the House. I don't think they're going to get the Senate, but I think they would more than likely delay any major, multi-trillion-dollar stimulus until he got in, because they would want to give him credit. They wouldn't want to give it to Trump. So they'd probably do some sort of piecemeal band-aids just to kind of hobble it over the finish line until he gets in. The bigger risk, though, is if he wins, how does President Trump react? Would he actually try and do a contested election like 2000?
Yes.
And that's that is the consensus, and probably an accurate one. I think for those of us that old enough to were trading at the time, I remember vividly my mentor at the time, actually the one who taught me everything. He said, "Alex, watch this. If this goes contested, it's going to really hit markets." And sure enough, that ultimately was really the pin that pricked the bubble. That was the .com. It wasn't anything financial. I mean, everyone says PE ratios, and yes, they were sky high, but really it was the contested election that was causing a lot of unknowns, and kind of there wasn't any certainty in the marketplace, and that's what caused ultimately for it to eventually roll over.
And the big difference, buddy, is that Gore took a bullet for America.
He did. I mean,
he took a bullet.
Yeah,
I mean, he did okay. It worked out for him.
No, I think personally, I don't think did a lot better.
He probably did financially.
Yeah,
but I don't think that Trump is Gore.
No, I think
it's contested. So
no, he won't lay down, more than likely. But hypothetically, if this scenario would play out, what really is the risk to financial markets is the lame duck. Yeah. And for those that aren't aware, that aren't American citizens, lame duck is the 2.5 month period between when an old president is defeated or it finishes second term, and then the new president gets in, which is usually around January 31st. So call it February. During that period, very little gets done legislatively, if not nothing. And if Biden wins, and this scenario would be that they would a lot more than likely delay any major stimulus bill of 2.6 or 3 trillion or whatever they may do. That would be pushed off more than likely. In many ways, it would be kind of like a Bush-Obama transition. As Bush was leaving, the markets were collapsing. Then once Obama, the markets financially didn't really bottom until after Obama had been inaugurated, and then major stimulus passed, and then from there the markets kind of rocketed higher.
Which Biden muscled through with Paulson.
Correct.
Something to keep an eye on during a lame duck
is
the Peking duck.
What's the Peking
duck?
And
where's Peking?
Oh, uh, but yeah. So the reason I think the lame duck is, I really think the lame duck session is important. Is that, well, why is that delay of 2.5 months important? Well, during that 2.5 month period, if we don't get stimulus, DXY is going to face a lot of upward pressure.
Yeah.
And commodities will get hit across the board. I think gold.
So will Taiwan. And with that being said, bro, I'm telling you, you are really good. You're a really excellent presentation. And, we could probably do this for a few hours. Do you think this completes your narrative, or we can keep going on with this series?
I think we're entering the final phase. I do think we need one more retest of that upper line on the euro to reject, and one more DXY to bottom. I think if we do, then that'll be the real kind of deciding factor. So I still think we need one more, but if we get that final one, that's a sign for you to start scaling in. And obviously, this is my Charts Coach is my platform for those of you that were interested and want to learn more about kind of my theses and stuff. I've launched a lot of new financial calculators, a bunch of stuff on the platform. I cover pretty much everything there is to cover. And then recently, I just launched my new audio podcast on the platform exclusively. The first episode is now live. It's a 60-minute long episode talking about the electric car revolution. It compares lithium-ion battery tech to all the new potential disruptive technologies. To kind of go through and say what are the biggest threats to Tesla motors, and I actually talk about one that could potentially be the biggest threat of all, and it's the last one you'd expect. And they're doing an IPO hopefully here in the future. So I kind of, if for those of you that kind of want more kind of other topics, I do a lot of audio podcasts other than just Global Forex Parity. It kind of goes through, and so what that new audio podcast will be as a part of the platform. For those of you that are more interested, you can always kind of sign up and see some alternate content that I produce as well. So
sign up.
I really appreciate it, Dale. I think
sign up for Alex. Sign up for Mystery.
I really appreciate it, Dale. But yeah, I think it's going to be an interesting. This week is going to be a lot of vol. And for those of you that I've been telling everyone on Charts Coach for the past, I actually told everyone on Charts Coach roughly 3 weeks ago to move to cash, because I saw a lot of vol coming. And honestly, for those of you that are in the options game, historically, we've never had such a high VIX at such a relatively high market valuation. So basically right now, it reminds me of the old Matthew Broderick movie from the 1980s War Games. Sometimes the best move is to not play at all. And from an option standpoint, the best thing right now is just stay liquid, be in cash, and be selective and picky, because right now I think market makers are taking a lot of these Robin Hooders to the cleaners, and they're just completely robbing them blind. So
prudence over valor from Mystery Trader 99.
Yeah. So, but Dale, I always want to thank you. I always enjoy our chats, and I appreciate you giving me the pre-election slot. That was a huge honor. So thank you so much for that. And hopefully we'll have another chat here soon. Well, it'll be interesting to see what happens given post-election the results, but hopefully some of these guidelines help guide you through the really volatile period coming up here in the next week or two.
They help me. Thank you for showing me some things that added conviction to some of my ideas and opened my eyes to some new things. Appreciate it, my trading warrior brother.
Anytime, Dale. Thanks again, brother.
Okay, buddy. So that's a wrap, everyone. We'll see you for Election Tuesday. Turn around Tuesday, spin around Tuesday. Don't just count your pips, count your blessings. We'll see you all tomorrow. Adios.